For decades, the government told you to save for retirement and rewarded you for it. Put money in your 401k or your traditional IRA, and you got a tax break every year you did it. It felt like a gift. But there's a catch that most people don't see coming until they're standing right in front of it. All those years, you never paid tax on that money, and the government always intended to collect. At a certain age, they stop asking and start requiring. They force you to pull money out whether you need it or not, and they tax it when you do. It's called a required minimum distribution, and the year it begins can hand you a surprise tax bill big enough to sting. So today, let's walk through the RMD mistake at 73 that catches so many retirees off guard, and how to see it coming. One quick note before we start. This is general information, not tax or financial advice. The details depend on your specific accounts, and I'll point you to where to get real help at the end. All right, let's get into it. First, let's be clear about what an RMD actually is. Through your working life, money in a traditional IRA or 401k grows without being taxed. That's the deal. You skip the tax now, in exchange for paying it later when you take the money out in retirement. An RMD is the government finally saying, later has arrived. It's the minimum amount you're required to withdraw from those tax-deferred accounts each year, so that money can finally be taxed. You can always take out more, you just can't take out less. For a long time, this started at age 70 and a half, then 72. But under the current rules, the age is now 73. So the year you turn 73, the clock starts, and you generally have to begin taking these required withdrawals. One important exception. This applies to traditional, pre-tax accounts. Roth IRAs are different, because you already paid the tax on that money going in. A Roth IRA has no required withdrawals during your lifetime. That difference is going to matter in a minute. Now here's the trap, and it's a sneaky one, because it's hidden inside a piece of flexibility that sounds helpful. For your very first RMD, the one for the year you turn 73, the government gives you a little extra time. Instead of taking it by the end of that year, you're allowed to wait until April 1st of the following year. Sounds like a nice break, right? Here's the problem. That extension only pushes back the first one. Your second RMD is still due by December 31st of that same following year. So if you delay that first withdrawal, you can end up taking 2 required distributions in a single calendar year. And both of them are taxable income, landing in the same year, stacked on top of each other. Why does that hurt so much? Because our income tax system has brackets, and stacking 2 years of withdrawals into one can shove a chunk of your income up into a higher tax bracket. It can do more damage than just that too. A bigger income year can cause more of your Social Security to become taxable, and it can trigger higher Medicare premiums through something called IRMAA, an income-related surcharge that looks back at your tax return. So one innocent-looking decision to delay your first RMD can ripple out into a noticeably larger tax bill, more of your Social Security taxed, and pricier Medicare, all in the same year. That's the surprise nobody warns you about. And here's why this sneaks up on so many people. Those accounts were designed to grow. Decades of contributions and compounding, all of it untaxed along the way, can turn into a balance far larger than you ever pictured back when you started. That's a wonderful thing, right up until 73, when the size of that balance is exactly what sets the size of your required withdrawal. The bigger the account, the bigger the forced income, and the bigger the potential tax bill that comes with it. In other words, the very success of a lifetime of disciplined saving is what creates the squeeze. Nobody sits down at 45 and imagines that doing everything right could hand them a tax headache at 73. But for the most diligent savers, that's precisely the trap, and it's exactly why seeing it coming early matters so much. Let me make it concrete with a simple made-up example. Imagine your first required withdrawal works out to around $20,000. Take it on time, in the year you turn 73, and it's $20,000 of income that year. Manageable. But delay it to April of the next year, and your second one, for maybe $21,000, is still due that following December. Now you've got roughly $41,000 of required income landing in a single year instead of being spread across 2. That's the jump that can tip you into a higher bracket and set off the ripple effects. The numbers are just an illustration, but the shape of the trap is real. A couple of quick clarifications on who this hits. Required withdrawals apply to traditional pre-tax retirement accounts, traditional IRAs, and workplace plans like 401ks and 403bs. And there's been good news recently. As of 2024, Roth 401ks no longer have required withdrawals during your lifetime, matching Roth IRAs. Also worth knowing for younger viewers planning ahead, the starting age is 73 today, but it's scheduled to rise to 75 in 2033, so the exact age depends a little on when you were born. If you're close, confirm your number. And there's a second, even more painful mistake, simply forgetting, or not taking enough. Because these withdrawals are required, the penalty for missing one is steep. If you don't take your full required amount on time, you can owe an excise tax of 25% on whatever you failed to withdraw. 25%. Now, there is some mercy built in. If you catch it and fix it promptly, generally within 2 years, that penalty drops to 10%, and the IRS can waive it entirely if the shortfall was an honest mistake and you correct it. But you do not want to be relying on forgiveness. This is a deadline worth putting on the calendar. So how much do you actually have to take out? The formula is simpler than you'd fear. You take the balance of your retirement account as of the end of the previous year, and you divide it by a life expectancy factor from an IRS table. In your early 70s, that works out to somewhere in the neighborhood of 3 to 4% of the account in the first year, and the required percentage slowly rises as you get older. Your account custodian, the company that holds your IRA or 401k, will usually calculate the figure for you and even offer to send it automatically. That automation is one of the easiest ways to make sure you never miss one. Now, the good news. This is one of the most manageable problems in all of retirement, because you can see it coming years in advance. The people who get hurt are the ones who ignore it until 73. The people who come out ahead start thinking about it in their 60s. Here's the core idea. There's often a window, after you stop working but before Social Security and RMDs have fully kicked in, when your taxable income is unusually low. In that low window, some people choose to voluntarily move money out of their traditional accounts, either by simply taking some out or by doing what's called a Roth conversion, shifting money from a traditional account into a Roth, paying the tax on it now, at today's lower rate, so it can grow tax-free and never trigger an RMD again. Done thoughtfully over several years, that can shrink the giant forced withdrawals later and smooth your taxes out instead of getting hit with one big spike. We'll cover Roth conversions in their own video because the timing genuinely matters. Let me put a finer point on those gap years, because they're really the heart of the opportunity. Picture the stretch between the day you stop working and the day your required withdrawals and full Social Security kick in. Often your 60s, sometimes reaching into your early 70s. In that window, your taxable income can quietly drop to its lowest point in decades. The paycheck is gone, but the forced withdrawals haven't started yet. That low-income valley is exactly when many people deliberately pull a little from their traditional accounts, or convert some into a Roth, filling up the lower tax brackets on purpose, while those brackets are cheap to use. Do that steadily for a few years, and you can shrink the mountain of taxable withdrawals waiting for you at 73, trading one nasty spike later for several small, controlled sips now. It takes some planning, but it's the closest thing there is to diffusing the whole problem before it starts. There's one more tool worth knowing if you give to charity. Once you're 70 and a half, you can send money directly from your IRA to a qualified charity through something called a qualified charitable distribution. It counts toward your required minimum distribution, but it doesn't count as taxable income to you. So if you were going to donate anyway, doing it straight from your IRA can satisfy the requirement and keep your tax bill down at the same time. So let's pull it together. Starting at 73, the government requires you to pull money out of your traditional retirement accounts and pay tax on it. Delaying that very first withdrawal can quietly stack 2 years of income into one and inflate your taxes, your Social Security taxation, and your Medicare premiums. Missing one entirely can cost you a 25% penalty, but none of this has to be a surprise, because you can plan for it a decade ahead. And you don't have to do it alone. A good tax professional, a CPA, or a fee-only fiduciary advisor can map out your specific accounts and show you the smartest years to act. The IRS also spells out the rules plainly at irs.gov. Because that's the real lesson here. The RMD itself isn't the enemy. It was always part of the deal. The mistake is walking into it blind. In the 1 year, it can cost you the most. See it coming, plan for it early, and it becomes just another line on the calendar. And I genuinely love to hear from you, because everyone's tax picture is different. Are you thinking ahead to your RMDs? And are you doing anything about it now, like Roth conversions in the low-income years, or giving straight from your IRA to charity? Or is 73 still a long way off and this is your first heads up? Tell me in the comments. Honestly, hearing how other people are planning for this is one of the most useful parts of this whole channel, and your strategy might be exactly what helps someone else start early. If this made required minimum distributions make sense, do me a favor and tap the like button. It truly helps other people your age find this before their 73rd birthday. And if you'd like more clear, plain English videos on the money side of retirement, consider subscribing.